Hello, today we have another stock analysis. Today we're going to look at Taiwan Semiconductor Manufacturing Company, which I think could be a great investment for many people. So we're going to take a look at some of the things they have going on in the news. We're going to take a look at what they actually do, and we're going to break down the fundamentals of the business, leading us to a valuation that lets us know if we think this company is overvalued, fairly valued, or undervalued. So let's get right into it. Starting off, they recently announced a $100 billion investment to build manufacturing plants or fabrication facilities in the US, in Arizona. So it was about 12 billion, then they moved it to 65 billion. Now they added 100. So 165 billion to build 5 total fabrication plants in the state of Arizona. I don't have the timing on that. So when we're looking at the cash flow, we understand there's going to be some capital spend regarding this, but do they have enough cash flow to handle this without impacting the fundamentals of the business? We're going to take a look at that as well. So $165 billion to put plants in the US over the coming years. I don't have a time frame for that. So just look at what they do. So this is a $1 billion company that manufactures computer chips for other $1 billion companies. So we have some of their customers: AMD, Amazon Web Services, Broadcom, Infineon, Intel, MediaTek, NVIDIA, NXP, Qualcomm, and Sony. So we know they make computer chips for a lot of big players. So when it comes to their market share, Apple is another one that's not on here, but Apple is another one. So you got to think about this. They make a lot of computer chips, and especially when with AI and other chips that are specifically designed for AI, add that or layer that with Amazon, Microsoft, Google, Apple. They're all creating and designing their own chips. So as these facilities start to be built in the US, think about who's going to make that. There's other people who make chips, but this is one of the biggest, and they're expanding. So who's going to be making those chips when those big time $1 billion companies design their own? This is likely to be one of those companies. So let's look at the chart really quick. Stock is trading at $176 right now. Recent slight downtrend over the past few months. It's up a little bit, a few percentage points from their recent low. A $916 billion business, a beta of 1.25. That means if the stock market goes up $1, the stock goes up $1.25. Same with down. It goes down 25% more than the market. That's the volatility rating. PE of 25. If this is a very high quality business, this is not an expensive multiple here. And earnings per share of $6.86. So let's get right into the revenues of the business. This has been translated from the Taiwan dollar to the US dollar to give us a more apples to apples comparison when we're looking at other companies. So 2015, 25.7 billion, 2024, 88.3. Now we do see this slight decrease of 4.5% in 23. However, they picked up their trend with a solid double digit 33% gain in 2024. Now, again, these numbers are published, but the final audit for 24 isn't finalized yet. So these are the numbers that are published on their website, but they're not quote unquote final. So we'll see if that changes. If there's a big change, I'll do an update, but I don't believe there will be. Let's look at margins. We have 12.5 to 49.5, 48%, a low of 46, high this year of 59, but they're at 56%. So solid margin trend is pretty consistent. So we like to see that. This company is, I think, pretty efficient for a manufacturing business. 24% average growth rate over the past 3 years. Still in the high growth state, and I believe they'll stay there for a while. Let's go to profitability. Net income positive each year, 9.3 billion to 35.8. We have 2 years where it dipped a little bit. Minimal here, pretty significant there, 14%. But again, they bounced back with a 39% profit similar to revenue. And the profit this year is above that of the 2 years ago. So that trend had a dip, but it's continuing to go up. So that's a good sign. Cash flow, after they have paid all of their capital expenditures, how much cash is left over from their operations? This is the money that they have for acquisitions, dividends, repurchase shares. So this is a very important number we want to look at. 8.1 in 2015, up to 26.5, similar with the profit and revenue. You have a dip here, but you have a super strong rebound, 203% gain. So as you see, this 26 is well above the 15 and 8. So that trend is continuing with the small dip, or this is a significant dip in cash flow in 2023. 85% growth rate over the past 3 years, 70 for the past 5 years. So solid there. Of course, you have a few dips in cash flow as the capital expenditures will go up and down depending on what's going on that year. However, solid uptrend. So we like to see that. Let's look at their balance sheet. How much debt do they have and how quickly can they pay it off? 5.8 in 2015. So it's trending up to 28.2, but the cash flow is trending up as well at a similar rate. Their worst year, 3.3 years. We love to see it under 3, but we'll understand if it's under 5. That's the range you want to be in. 1.1 this past year, they average at 1.6. So the cash flow that they produce in any given year, on average, they can pay off their debt in 1.5 years. About 1.5 years. So that's solid leverage position. This has a dividend. They're paying out 68 cents per quarter right now, and it's steady rising. But look, 40% payout ratio, that's the most important. This isn't the most important thing to me because dividends can grow depending on the price. It could be a low yield or not, but 40% payout ratio, that means as someone who either wants dividends or who needs dividends, needs that income because they're an older investor, thinking 35, 40 and up. We want to know what that payout ratio is because we want to know how safe the dividend is. We don't want to see a payout ratio of 98% as like a Coca-Cola, Verizon. We want to see someone who's sub 50 and still has a lot of growth to accomplish, which means the dividend that they're paying now is safe and they have the ability to grow that dividend aggressively if they choose to, or at least consistently. So a payout ratio of sub 50, some people say under 30, but I say sub 50 depending on the growth of the business. 40% is a solid payout ratio. It means they have a lot of runway to continue to grow it. So we love that as well. Economic value added. What are your returns on capital? And compare that to the weighted average cost of capital. Returns on capital, when I say capital, I'm talking about the equity within the company and the debt. What's the structure? How much debt do you have? What's the interest rate? How much capital do you have? What's the opportunity cost of that capital? That's the cost of capital. And I want to know what's your returns on the debt and equity that you have. Very high, 24% compared to a cost of capital of 7.8, which means on average for the past 5 years, the entity existing and operating is adding economic value to the shareholders of about 16.25%. That's a solid rate. Very high. That is great to see. So now valuation. So this company has been growing their cash flows at about 70% a year. With one, we want to be safe. We want whatever the growth rate is or has been or what people are estimating, we want to make sure we're being reasonable and we're in a safe range. And two, we also know they're going to have some capital spend, heavy capital spend within the next few years. So it's going to impact their cash flows. However, I believe that the cash spend is going to add value to the shareholder in the long run. So I'm estimating at about 35%. This is around the average of analyst estimates that I've seen. 35% growth rate for the next 5 years, a discount rate of 10%. Why 10%? Because I can invest that money in the index fund, reduce risk, and get 10%. So I want to make sure my hurdle rate is at least 10%. Terminal value of 20 times free cash flow. If I were to sell the stock in 5 years, I believe I can get at least 20 times the free cash flow as far as my return on investment. The market cap would be at least 20 times the free cash flow amount. the current free cash flow. And just to give you reference, right now they're trading at 29 times free cash flow. So I believe I can get at least 20. I believe each input makes sense and is also giving me some margin of safety. With that said, I believe the stock is worth about $247 per share. So we got about 40% upside. So the share price is here. I believe it's worth this range here. And I do this fair value range. I do like a plus or minus 10% of 223 to 272. Why? Because even though I'm calling out a specific price, this is still an estimate. This is not an exact science. And we want margin of safety and we want a range because we could be wrong. When we're investing, we want directional accuracy. You don't have to pinpoint the stock price to the penny on your estimate. You just want to make sure you're in the right direction. You want to be in a position where even if you're wrong, you can still make a lot of money. So this is why we focus on making sure we're in a range. Also, with a quality business like this, we're not so concerned with looking for deep value because you have to pay a little bit more for quality. Quality investments cost more. Quality products cost more. There's no different with investing. It can cost more. So this could be an opportunity. If these estimates are safe or accurate, this is an opportunity to find some really solid value with TSM. However, even if could be wrong, like you may say 35%, let's play around with it. You may say, I think their capital spend is going to be heavier. I don't think they're going to grow at the same rate. I say it's going to be 15% or 20, let's do 25%. If that were the case, then they're pretty much right on par with fair value. In my opinion, because of the quality of the business, as we've seen before, this is a good buy. When it comes to quality businesses, you can't always look for deep value. Sometimes you just have to make sure you're not overpaying for it. Buy that fair value and hold for a long time, and you'll be in good shape. So that's my estimate there. Again, 35% growth puts me at about 247. I think this is a great stock at a great value and long-term play, definitely with the fabrication, because all this spend is going to add value to the shareholder. This is not something you want to buy and then sell while they're spending all this money to build these facilities. It's something you want to hold after they build their facilities and have this increased capacity to fund it, to produce all these chips for all these other companies that are going to come along, all the needs and products that are going to move to having chips in them, whether we're talking about smart products or there's everything that's we know now has more technology added to it, and that's only going to increase. So this looks like to be a great investment for a lot of people. So I really like this one a lot. It's definitely one I'm looking to buy real soon. So I hope you enjoyed this analysis. Let me know what you think in the comments, and I hope to see you in the next video.